Come with me now. Go with me now. I'm gonna take you down. Go with me now. I'm gonna show you how. Go with me now.
All right, welcome back. So why don't we do a quick review of currency exchange and how an appreciated currency or a depreciated currency will affect exports and imports of a country. So we'll do that real quick, and then the focus of today's lesson is called the balance of payments. Alright, so you've probably already read through this first screen, so we're going to look at what happens when U.S. income decreases. How does that affect trade between the U.S. and Swaziland? So to begin, let's just roll over here to a blank sheet. It says, assume the U.S. and Swaziland are trading partners. If the current financial crisis causes U.S. income to decrease, show and explain what will happen to the following. Alright, so what I'm going to do is I'm going to draw graphs for both the U.S. dollar and the Swaziland lilangeni. Alright, quantity of dollar, and let's see, this is the dollar market, and it's going to be priced as lilangenis per dollar. And then right next to that, I'll go ahead and draw the lilangeni market. Okay, and this is priced dollars per lilangeni, quantity of them. You got a supply curve and a demand curve. Alright, so the value of the Swaziland lilangeni. So here's what happens. If our incomes go down, is it likely that we will be buying more goods from Swaziland or fewer goods from Swaziland? Hopefully you answered that we'll buy fewer goods from Swaziland, and that's the case generally. If anytime your incomes are down, you're going to buy less of things. So the demand for their currency will also fall, which means their currency is going to depreciate. Alright? So basically we've answered part A. Alright? But to show you the other side of the equation here, so to speak, if we're demanding fewer lilangenis, that means that we as U.S. citizens are supplying fewer U.S. dollars to the foreign exchange market. Therefore, the dollar will appreciate. So again, they all go opposite directions. Lilangeni depreciates, that means the dollar has to appreciate. So part B, excuse me, as a result of this change in currency values, what's now going to happen to the price Americans would have to pay for Swaziland zebra meat? So since it costs less to buy the lilangeni, that means it's going to cost less to buy Swaziland's goods. So, part B, zebra meat is going to go down in price. Decreases for Americans. Okay? And then finally, part C, since the price of zebra meat has gone down for Americans, that is, then we're probably going to purchase more goods now from Swaziland. So the exports are going to increase. So that's kind of a review of what we did last time. This is a pretty good example of a short free response question for your test. Alright, so let's move on to the new stuff. Alright, so basically this is still the old stuff, I'm sorry. So this is again still review from last time. So just make a note here that appreciation of a currency is going to cause imports to increase and exports to decrease. And then a depreciation of a currency is going to cause imports to go down and exports to go up. So that's basically how currency values affect trade. Alright. Now we're going to look at the balance of payments. This is the new stuff. So generally speaking, the same amount of money comes into a country as goes out. And so why is that? Well, here's what would typically happen in a freely traded currency. Okay, the U.S. is going to send money to China, and in return, China is going to send goods to the U.S. Okay, now over time, this is going to cause the Chinese currency to appreciate, and then that is going to cause the Chinese to then buy U.S. goods and ship currency to the U.S. And so over time, the amount of money that leaves our country should equal the amount that comes into our country. And that is the case, okay? I said generally speaking, that is the case, okay? Now, we're going to see why that happens in greater detail, and I'm going to look at the special case with China. Because China doesn't actually, their currency doesn't actually change value, and they don't really buy a lot of U.S. goods, okay? But there is something else that happens, and so we're going to examine all of that today. Now, the balance of payments, this is important, okay? This is how the U.S. government keeps track of U.S. currency going in and out of the country. And the reason that's important is because it will help policymakers to understand what's going on in the world. Because, again, the balance of payments is going to show us a lot of different information, okay, besides the measure of money, okay? It's going to show us more info, which, again, we'll get to that as we continue this. So, just a little bit of vocab. Inflows of money are referred to as credits. So just like with your bank account, if you deposit money, your account is credited because money comes in, okay? Outflows are referred to as debits. Just like when you use your debit card, money is removed from your account, okay? Now, the balance of payments is divided into 3 accounts, all right? We have 3 actual accounts that we look at. We have what's called the current account. We have what's called the capital/financial account, and in recent years it has been called the financial account more than anything else. I believe the regular textbook still refers to it as the capital account. So make sure you know what we're talking about here. Then we have what's called the official reserves account. That is the least used of the 2. All right? Now, it turns out these accounts must add up to 0. So let's say the current account is negative 100 and the financial account is positive 98. That means the official reserves account would have to be positive 2. That way the whole thing adds up to 0. Alright? If it adds up to 0, that means that the exact same amount of money left our country as what came in. Alright, so let's talk more about the current account. The current account just measures the value of our exports and imports for the most part. Okay? There's a little more to it which we'll discuss, but basically the biggest chunk of it is just our exports and our imports. So when we export something to another country, that country sends us money. So exports create a credit to the balance of payments. And when we import goods, that means we're buying stuff from other countries, therefore money has to leave our country. And so imports create a debit. Alright? Now, there's other categories that are part of the current account. We have what's called investment income. Alright? So, for example, if you have a bank account in Canada and once a quarter the bank sends you what interest you've earned, well, that's called investment income. And so when they send you that money back to the United States, that creates a credit to our current account. Okay? It could be profits. Okay? Maybe you own a business in another country. Well, whatever profits you take from the business and bring back home, that's called investment income. So, the example here is that if I buy a cuckoo clock company in Germany, the profits that I earn would be accounted for in the current account as investment income. Alright? Now, the opposite's also true. If a foreigner owns a company here in the US and then they take the profits back to their home country, then that would be a debit to our current account as investment income. Alright, then we have what's called net transfers. This is just foreign aid, like government to government, or it could be remittances. Remittances is a big thing. Okay, remittances is either the second or third largest industry in Honduras. Okay, that's just where people move to the US, they earn money here, and then they send some of that money back to their families. Okay, that's called remittances. That's under the net transfers category of the current account. So my example is if I get a job in Canada and then I send money home to my wife and children, the money I send home is part of the current account. Because it's coming into the US, we would call it a credit, and it's part of the net transfers. Now, what is more common would be foreigners earning money in the US and then sending that money back to their home country. That would create a debit to the US current account as a net transfer. Alright, so there's 3 categories of the current account. It can be a little bit complicated, so just make sure you have all this written down. That way if you have to refer to it, you're ready. Okay? Then we have what's called the capital/financial account. Alright? Now, there's 2 parts of this, and this is basically where it gets its name. You have what's called the capital account, which is essentially just debt forgiveness. Now, I note this is a very minor part of the financial account. So this would just be government to government type debt forgiveness. Okay, Egypt owes the U.S. $1 million. The U.S. says, you guys just accept it as a gift. That would be debt forgiveness. All right, again, it's a very small part. The larger part of it is called the financial account. And this is where we account for the payment for real and financial assets. Okay, a real asset is really, think of this as real estate or buildings, okay, companies, okay, trademarked type stuff, things like that is real financial assets or real assets. Then the financial assets are going to be things like stocks and bonds, okay? So generally speaking, this is accounting for the purchases of things that are only useful in the home country. So for example, when I do buy that cuckoo clock company in Germany, okay, the profits I earn come back and they're accounted for in the current account as investment income. However, when I buy the cuckoo clock company, I'm taking money out of our country and I'm sending it to Germany, and I'm buying something that I can't bring home with me. Okay, I cannot bring the factory and everything that's involved in the cuckoo clock company back to the United States. Okay, so that portion or that transaction would be accounted for in the financial account. Okay, so again, it's things like real estate, factories, stocks, bonds. All right, that's the financial account. Again, I don't expect this to be just super easy, okay, but that's why I'm giving you plenty of examples, and then when we discuss it in class, I'll make sure everybody's clear. Alright, so here's some more examples. So this is some stuff, these are all things accounted for in the current account, and then these are all the things that are accounted for under the capital financial account. Alright, so just good, these are good examples. Alright, so trade deficits. Now, here's what happens when we have a trade deficit. That just means that our imports are greater than our exports. So there's something that goes along with that in the balance of payments. So whenever there's a trade deficit, we also have a current account deficit. Okay? So all this means is that in the current account, we're sending more money outside of the US than what is coming back in. Okay? Now, if for some reason we had an account surplus, that would be where more money came into the US than what left. Okay? Now, for us and for my entire lifetime, our current account has had a current account deficit. Okay? And the reason for that is because we buy more from the world than the world buys from us. But on the other hand, on the financial side, we have a financial account surplus. So there's a lesson to be learned there. Whenever there's a current account deficit, there has to be a financial account surplus. Alright, so here's some examples of how this would work. Okay? So our current account is made up of four things. It's our balance on goods, our balance on services. It also includes our net investment income and net transfers. So those are the things that we just described earlier. The capital financial account, it includes debt forgiveness as a small portion of it. Then it's got foreign purchases of U.S. assets and then U.S. purchases of foreign assets. Okay? So foreign purchases of U.S. assets, that creates a credit because money's coming into our country. But when the U.S. purchases foreign assets, that would create a debit because now money is leaving our country. Okay? And then the difference between these two accounts is what we call the balance of payments. They should balance. Okay? So if this is negative 100, this should be positive 100. That's not always the case though. Sometimes there's just like a rounding error or some small discrepancy. And that is when we use the official reserves account. Okay? So like I had mentioned earlier, if this was negative 100 and this was only positive 98, then we actually have a negative $2 balance. So what's the official reserves? This is the import or the export of foreign currency. So what do I mean by that? Well, first of all, official means that it's conducted by the government. Okay? So the government owns foreign stocks of currency. So our government owns billions of dollars worth of euros, yen, all kinds of foreign currency, okay? So if for whatever reason our balance of payments is negative, that means we need to bring US dollars back into the country. And so more foreign reserves will be sold so that more US dollars could be brought in. So in this example, we're going to sell $2 worth of foreign currency so that we can bring in $2 worth of US currency. And so the balance of payments would then equal 0. Okay? That's probably the most confusing part, is just how the official reserves are used. Okay? So just remember, the goal is to make sure the same number of dollars comes into our country as leaves our country. So if 2 extra dollars left our country, we got to bring them back. And the way the official reserves are used is we sell foreign currency so that we can buy US currency, and that balances it out. Alright, so for example, if you buy a parachute from Germany, number one, does that create a account deficit or a surplus? Or I'm sorry, a debit or a credit? Okay, if you buy a parachute from Germany, that's an imported good, so that's going to be a current account debit because money leaves our country. Now, if you buy a parachute factory in Germany, like the whole factory, okay, it's still going to be a debit because money leaves the US, but now you're buying something that is a real or financial asset. Therefore, it's the financial account. Okay, so that would be a financial account debit. Finally, if you earn profits from that factory and you bring those profits back to the US, that would be a credit, and then that would be for the current account. Okay, so that goes back to just memorizing what all is accounted for in each account. Okay, the current account was imports, exports, investment income, and transfer payments. Okay, the financial account was real assets and financial assets. Those are the main things. Alright, so here's another example. So remember, we had those hamsters buying Kias. Well, when the hamsters, and they're American hamsters, when they spent billions of dollars on Kia Souls, that created a US current account debit or credit. Money left the US, so it's a debit. Okay? But what did Kia and therefore South Korea do with those billions of dollars? Well, it turns out, oh, I'm sorry, I'm not finished with this yet. So for the US, that was a current account debit. But from the Korean side, those were exports, so it became a current account credit for them. Okay? Now we have the next part. So Kia took $1 billion of those dollars and they built a new factory in Georgia. Well, that created now a financial account credit for the US and a financial account debit to South Korea. So here's why this is important. Alright, so as I mentioned earlier, the money that comes into our country will always equal what goes out. Okay, so when we import goods, that gives foreign entities US currency, which they then have to spend in the US. So either they're going to buy US goods, or in this case, they're going to build a factory in the US and employ thousands of Americans. Alright, so that's basically how the balance of payments is working. Here's some more examples. Alright, when I buy toys from China, all of this creates a current account deficit in the US. But what does China do with that money? Okay, this is important to know because right now they don't typically buy US goods. They can, but they don't typically. So here's what they can do with that money. Okay, they could buy US goods, so that's one way the money could come back to the US. Or they could buy US real assets. Okay, these are real examples. This happens to be the Hummer company, part of General Motors at the time, and now it is owned by a Chinese firm. Okay, or they could buy US financial assets. This is very common. Okay, approximately $1.3 trillion of our debt is owed to China. Well, this is why, because they took a lot of those dollars that I spent on toys and they used those dollars to finance US debt. Okay, A fourth thing they could do is just waste it. But typically, it's these two things that they do the most of. Okay. Of course, next year when you go to college, you're going to see a lot of foreign students. Okay. Maybe that's right here. Okay. So they use the U.S. dollars for some benefit in the U.S. That's the whole point of this. Okay. So the balance of payments always works out to where the number of dollars that leaves our country will equal the number of dollars that comes back. Okay. So here's an example. So this is a real example from 2005, I believe. Yes, it says 2005. We had $893 billion in exports. We had $1.7 trillion in imports. That gave us a balance on goods of negative 782. So that's part of our trade deficit. Okay. But we had a surplus on services. So we sold 380 billion and purchased 322 billion. So that gave us a surplus on our services, and then negative 724 was our total trade deficit. Okay. Then we had investment income of negative 2, and then net transfers of negative 83, for a grand total of a balance on our current account of negative 805. Okay. Then we had our capital account, which is just the debt forgiveness, of negative 6, and then our financial account of positive 1298. That's the foreign purchases of U.S. assets. And then we had U.S. purchases of foreign assets of negative 147, for a grand total of the balance on the financial account of positive 811. When added to the negative 6 gives us positive 805, and so our balance of payments was 0. So exactly the same amount of money left our country as what came back in, and that's how we account for it in the balance of payments. Alright, so here is an example of a test question. If a country has a current account deficit, which of the following must be true? Well, we know that whatever money leaves the country, it has to come back. So if the current account is a deficit, that means it had to come back through the financial account. So what is it? What is our answer? There it is. It must show a surplus in the financial account. All right. So here's another example. If you had to, could you add this up? Okay. The U.S. is experiencing a balance on goods deficit or surplus. Well, here's our balance on goods. Okay, it says here 100 was exported, 80 was imported. That leaves a balance of positive 20. So it's a surplus of 20. The U.S.'s balance on goods and services. So now we have to add up services and goods. So our services was negative 50. So these two added together gave us negative 30. Okay. So do we have that? Yes, we have deficit of 30. The U.S. balance on the current account. So now the whole thing, okay, the whole current account, which is all of this. Okay. If we add these guys up, you get a positive 5. And so we add both of these together, we get negative 25. So the U.S. current account balance is a deficit of 25. The balance on the capital and financial account, that's where we add these three numbers up. So positive 45 plus a negative 10 is positive 35, plus a negative 5 is positive 30. Okay, so it is a surplus of 30. And then that means that we have a balance of payments surplus of 5. And the official reserves account indicates that the U.S. has to import or export $5 billion of its stock of foreign reserves. Well, it's going to sell the foreign reserves, so it's going to export those in the amount of negative 5. Oh, wait a minute, I messed that up. Whoops. That means it's going to import foreign reserves, export U.S. dollars in the tune of negative 5. Okay? Alright, and so that's how we balance this out, so the whole thing's going to add up to a big 0. Alright, so what causes these trade deficits? Well, it's pretty straightforward. Anytime we have strong economic growth, we're going to buy more foreign goods. Okay? Or if we choose not to save our money, we're going to buy more things. Okay? An appreciated dollar is going to cause us to buy more foreign goods. Or anytime the government has big budget deficits, that means it's going to give the opportunity for foreigners to purchase some of that budget deficit, which means you're going to have a financial account surplus on this last one, but if there's a surplus here, you have to have a deficit on the other side of it. So there's some causes of the trade deficits. Okay? And so how do these things affect the balance of payments? All right, if U.S. incomes increase, what would you expect to happen to the current account? Well, here's a chain of events, okay? Incomes increase, that means we're going to increase our imports, which means we send more dollars outside the country. So we're going to have a current account deficit. Or debits to the current account. How about this? The dollar depreciates. How might the current account be affected? Well, a depreciated dollar makes U.S. exports more expensive. Okay? No, I'm sorry, less expensive. Duh. So our exports are going to increase, which means that we're going to bring money into the country. So that's going to create some current account credits, or it could move towards surplus. Okay? If U.S. imports increase, what would you expect to happen in the financial account? All right, imports affect the current account. Okay, so more imports is going to create current account debits, right? So the opposite has to happen to the financial account. So that would create financial accounts credits. Lastly, if China increases its purchases of U.S. debt, how does that impact the financial account? When they purchase U.S. savings bonds or treasury bonds of any type, that means they're sending U.S. dollars into our country. So that would create financial account credits. All right. So essentially, we've finished the lesson. So if you want to be done, you can. I was going to go through a free response question just to kind of tie everything together in this unit. Okay. So it says balance of payments accounts record all of a country's international transactions during a year. Two major sub-accounts in the balance of payments accounts are the current account and the financial account. In which of these sub-accounts will each of the following transactions be recorded? Okay, if a U.S. resident buys chocolate from Belgium, that's an import, therefore it affects the current account. Okay. A U.S. manufacturer buys computer equipment from Japan, that also becomes an import, therefore that also affects the current account. Okay, so it's trying to trick you there. How would an increase in the real income in the U.S. affect the United States current account balance? Well, if our income rises, we purchase more imports. So let me change color. Okay, so more imports cause the current account to go to deficit, or it causes current account debits. Okay. Finally, using a correctly labeled graph of the foreign exchange market for the US dollar, show how an increase in US firms' direct investment in India will affect the value of the US dollar relative to the Indian currency, the rupee. So let me do that one over here. Alright, so we have two currency graphs. I'm going to do dollars, which is priced at rupees per dollar, and I'm going to draw the rupee. And it's priced dollars per rupee. Alright, so in order for the US to invest in India, first the US has to convert dollars into rupees. So that means whoever's doing the investing is going to run over to the foreign exchange market and increase demand for the rupee. That causes the rupee to appreciate. As payment for the rupees, the US investor has to supply US dollars to the foreign exchange market, which depreciates the dollar. So the question was, how does that affect the value of the US dollar relative to the Indian currency, the rupee? So the answer is that the dollar depreciates, as shown in our graphs. All right, I feel like we've accomplished a lot here, so I'm gonna let you go.
Come with me now. Come with me now.